So participants in the FX market. Forex market is known to be the largest of all financial markets, with a daily turnover in excess of 6.6 trillion US dollars. And this is according to the Bank for International Settlement report of April 2019. So this market is dominated by banks who quote the exchange rates. So they buy and sell prices for different currencies. And other key participants are the government, companies, and the individuals, which is the retail market, which we basically the retail market. So me and you. Main locations for the FX market, UK is dominating 37%, the US is dominating 19%, Singapore 8%, Hong Kong 70%, for Japan 6%, others get the rest, which is 23%. So in Africa, FX trading has been slower to develop, and it's mostly retail and interbank trading. So between two banks and usually local banks, it's what we're having in Africa. So participants in the Forex market, we have the liquidity providers, we have the brokers, we have the banks and institutions, and we have the retail market, retail individuals. So we basically be learning the liquidity providers, or the market makers, and the brokers. Let's start with the liquidity providers. A Forex liquidity provider refers to an individual or a corporate entity that provides services of being a buyer and a seller of exchange rates in various currencies traded in the Forex market. The Forex market is known to be the most liquid market. This is because the liquidity providers stand to provide liquidity. They stand to provide the price at which they will buy from you and the price at which they'll sell to you. So at any time you fill in your order, immediately your order, after executing your order will be filled. The range of movement of the currencies, the Forex market, is quite small, usually 1 or 2 over 10,000 of a point. So the market volatility is quite low compared to the stock markets, compared to the crypto markets. So basically, you would find the currency pair moving at least 2%, at most 2% a day. But you find for the stock market, you find a stock moving even 400% in a day. So the range of movement is small, and it requires a large amount of money to be able to buy or sell currencies. So in the case of the Forex market, the role of the liquidity provider is to put in place conditions that ensure the stability of prices of the currency pairs by taking buy or sell positions in these currencies, from where these positions can be sold off to other lesser trading entities such as market maker brokers. So they stand there to take in your orders, but later they know where they sell those orders. So we have the tier 1 liquidity providers and the tier 2 liquidity providers. So the tier 1, these are the one who are the apex, who are the apex of the food chain. Like they usually offer pricing to the market maker brokers, who in turn, these market maker brokers offer some markup pricing so to the retail clients. So usually this pricing from the tier 1 liquidity providers are used as the benchmark by the market maker brokers. So the tier 2 liquidity providers operate at the level of interbank Forex markets. They function strictly as market makers that provide pricing to retail clients using a daily index. So basically they deal with the retail clients. By definition, we can define these market makers as a company which is ready to sell or buy an asset at a public quoted price on a regular and continuous basis. In this manner, market makers enhance the architecture of the Forex market in terms of trade executions, ensuring that there is always a buyer or seller to fill the trade orders of the retail clients at any point in time. So this is why you find that the Forex market is the most liquid market. So how do these market makers make money? They make money from the compensation they receive from the price differential between the bid price and the ask price of a currency pair. And as I told you earlier, this is known as the spread, and is taken from the accounts of the retail trader as soon as you execute your order. So as soon as you execute your order, the spread will be deducted. By acting as counterparties, they also receive profit from losing trades in the market. So your loss is their gain. Retail traders typically trade Forex with a few hundred or few thousand units of one currency or another. This is not enough to maintain the desired liquidity in the market. Like it requires a very large amount of money to move the market, for the market to swing. So this is where the role of market maker is highlighted, and this is where you come to find the market maker method that we'll be learning on this strategy to be significant. As we'll be learning how these market makers operate, how these market makers make the market swing and trade along with them. So their operation greatly increases liquidity in the market, and this is where you find the market swinging every day. We also have the brokers. A broker can be an individual or a company. Mostly a broker is a company that buys and sells orders according to their traders' decisions. So they are like the counter, they stand between you, the dealer. So between an investor and the dealer. And brokers earn money by charging a commission or a fee for their services. So you find that in this brokerage system, you find we have the commissions, we sometimes have the rollovers, the swaps. There are two types of brokers. We have the market maker brokers and the ECN brokers, the electronic network brokers. Now, how do the market makers brokers work? Market makers make or set both the bid and ask price on their system and display them publicly on their code screen. So they stand prepared to make transactions at these prices with their customers, who range from the banks to retail Forex traders. In doing this, market makers provide some liquidity to the market. As counterparties to each FX transaction, in terms of pricing, market makers must take the opposite side of the trade. So wherever you sell, they must buy from you, and vice versa. So the exchange rates that market makers set are based on their own best interest, as that's their profit. On paper, the way they generate profits for the company is through their market making activities, is with the spread, which is charged from their customers. So we learned it earlier. Usually spreads are kept fairly reasonable as a result of very steep competition that we have between numerous market makers. We have plenty of them. So the competition is stiff. So they want you as a client by offering you a very small, very narrow spread. As counterparties, many of them will then try to hedge or cover your order by passing it to someone else, so they'll do that. There are also times in which market makers may decide to hold your order and trade against you. They'll do that. So the pros of using the market maker brokers is that their trading platform usually comes with free chatting software and newsfeed. You find some of them have more user-friendly trading platforms, and currency price movements can be less volatile compared to currency prices quoted on ECNs. although this can be a very disadvantage to scalpers. And the disadvantages for using market makers. Market makers can present a clear conflict of interest in order executions because they may trade against you. And they may display the worst ask or bid prices. And this happens a lot in the market. Like you find the spread is wide at sometimes. It's not even a time when you expect that the spread could be wide, but you find the spread is wide. The worst bid and ask prices. It is possible for market makers to manipulate currency pairs, currency prices to run their customers' stops. And you will find that at a certain, when you take a trade and you put your stop loss at a certain broker platform and in another broker platform, and one of them has hit the stop loss and the other one has not, simply because one of them has manipulated the currency prices, and they can move 10 to 15 pips away from other market rates, and you may not identify it unless you have maybe other broker platform that you can simply reflect and see if that occurred. And a huge amount of slippage can occur when news is released. Like you find that maybe the price was around 1.100 and it jumps to 1.1005. Like you find a gap there. So that's slippage can occur when news is released, and you find that your future stop loss, like you're trading the news and your future stop loss maybe 15 pips, and you find market makers they, when price reaches your stop loss, it does not close your order, and because the volatility is high, you find that price still goes against you and you'll be in a very huge loss, and that's called slippage. And during this news release, you find that they may also freeze, especially when the volatility is very high. You find that the MT4 is freeze. The MT4 has frozen. And many market makers frown on scalping practices and have a tendency to put scalpers on manual executions. You'll find that you're putting your orders and they give you a message like your orders will not be filled. You are you have put your order in the wrong quotation, so they basically do not give you the best ask or the best bid. That's basically what it means for the scalpers. Now, those are the market makers, brokers. Now, how do these ECN brokers work? The electronic communication network. So ECNs pass on prices from multiple market participants. So you have like a pool of participants, and all of them are these banks, these market makers, as well as other traders are connected to the electronic communication network, and they pass in prices from all of them and display the best bid or ask quotes on their trading platform. So you may find sometimes the best ask is the same as the best bid, and you find that a certain pair, maybe EURUSD or USD GPY, is having zero spread. This is because the best ask and the best bid are on the same price. So ECN type brokers also serve as counterparties to Forex transactions, but they operate on a settlement rather than pricing basis. Like fee spreads, here you find that ECN brokers have variable spreads. And during very active trading period, you can sometimes find that you find zero spread in very liquid pairs such as the majors, EURUSD, USD JPY, JPUSD, USD So electronic networks make money by charging customers a fixed commission for each transaction. So you find the commission that is available for your ECN is greater than for the market maker brokers. And for the market maker brokers, most of them do not have the commission. Most of them, they benefit from the spread directly. So what are the advantages of using the ECN brokers? They can usually get the best ask and bid prices. It's not usually most of the time because they are derived from several sources. It is possible to trade on prices that have very little or no spread at certain times. Genuine ECN brokers will not trade against you, never. As they will pass on your orders to a bank or another customer on the opposite side of the transaction. So that is what they basically do. Prices may be more volatile, which will be better for scalping purposes. So for scalpers, ECN brokers are your choice. Since you are able to offer a price between bid and ask, you can take on a role as a market maker to other traders on the ECN. And the disadvantages of using the ECN brokers is that many of them do not offer integrated charts and newsfeed. Their trading platform tends to be less user-friendly. It may be more difficult to calculate stop loss and break-even points in advance because of the variable spreads between the bid and ask prices, and traders have to pay commissions for each transaction. So basically, those are the two types of brokers. Now, let me give you an advice on how to choose a broker. Before trading Forex, before trading FX, you need to set up an account with a Forex broker. You may feel overwhelmed by the number of brokers who offer their services online, and deciding on a broker requires a little bit of research on your part, but the time spent will give you insight onto the services that are available and fees charged by various brokers. So it is very important for you to choose the best brokers. I use the best brokers. They have minimum trading costs and they're regulated. So they won't sign off with your money. And they are regulated under the Financial Conduct Authority of the UK, the FCA. And you can sign up simply for TemplaFX, for the market maker brokers, and for the ECN broker, they have the tick mill here. So you can simply go through the book and you'll find the links there and you can sign up real quick to your broker. So thank you for listening. Until next session.